One of the biggest reasons why people won't consider dividend or income investing is because they don't want to pay taxes on their dividend income. This is likely a top 2 or top 3 reason why some people refuse to consider it. And I think that's unfortunate because dividend investing is the truest form of passive income that exists. If you Google passive income ideas, then what you'll realize is the vast majority of other so-called passive income strategies aren't actually passive. Looking at this article from Bankrate, they actually give a list of passive income ideas, but most of these aren't actually passive. Write an ebook. It takes a long time to write something that people will actually want to pay for. Sell photography online. There is so much competition that already exists, and you have to own really expensive equipment to take high quality enough photos, which you obviously have to take and then edit and so on. Actually, the majority of these top passive income ideas all revolve around investments that pay distributions. And not once have I ever heard anyone complain about the taxes they had to pay for selling their ebook or photography. With dividend stocks and funds, you can buy something and then largely forget about it. With the exception of checking on the health of your holdings every few months, you'll keep getting paid no matter if you check your stocks every day or almost never. To say no to what's likely the easiest income stream available to everyone, all just because you'll owe some taxes on that income, I don't think makes a great deal of sense. It takes very little effort, and it's another source of income that you can rely on if there's an emergency in your life. If you stay dedicated, it'll eventually match or even exceed the income you make at your job someday. This prejudice that exists against dividends is so unique as I don't see people reject other sources of income because of the taxes. No one has ever turned down a bonus or a salary increase at their job because they'd have to pay more taxes. No one has ever said, "Oh, I make too much money, I need to find a different job that pays less so I'll owe less taxes." Now, I understand if someone doesn't want to hold a master limited partnership. These investments issue all of their shareholders a complicated tax form at the end of the year called a K-1 that you have to file with your income taxes. It costs more money to use TurboTax or to have a tax preparer handle it. So it's completely understandable if people don't want to hold these companies, even though they can offer some pretty good benefits. To be clear, I don't enjoy paying taxes myself. I'm not an advocate for raising taxes or anything like that. But as I'll show you later in this video, your aversion to dividend investments that come with a higher tax bill could be hurting your financial well-being. Another example would be owning a rental property. Compared to dividend investing, owning a rental property is one of the closest ways to earning passive income. If you're willing to fork over a percentage of your rental income to a property manager, they can take care of almost everything, from maintenance to finding a tenant for you. I have never met anyone who wouldn't consider owning a rental property because they'd have to pay taxes on their rental income, or anyone who sold their rentals because of their taxes. Rental income is taxed as ordinary income, just like some high-yielding investments that exist, like business development companies. Now you're probably saying, I can do things like deduct expenses and taxes from it, and I still own a house at the end of the day. There are strategies that I can use to lower my tax bill. The exact same thing is true for dividend investing, and at the end of the day, you still own shares of a stock. It's significantly easier to invest in a dividend holding than go out and buy a rental property, by the way. But there's a lot of different strategies that investors can use to reduce or even eliminate the burden of being taxed on their dividends. Let's start with the type of account you're doing your investing in. All dividends that you receive inside of a Roth IRA are completely tax-free. As long as you're following the withdrawal rules, you will never have to pay taxes on any of your dividend income inside of a Roth. The only exception that I can think of is if you earn more than $1,000 per year from a master limited partnership. But you should never hold an MLP inside of a retirement account because if you do owe taxes, it can make filing them much more difficult. And besides, they're not considered dividends when they're paid from an MLP. It's actually referred to as partnership income. But other than that, a Roth IRA will completely eliminate the gripes you have about taxes. Even if you pursue dividend investing inside of a traditional IRA, since Roths have only been around since 1997 and not everyone watching this did their investing inside of a Roth, there are still tax benefits to it. Dividends you earn in a trad IRA are tax deferred, meaning that you don't owe taxes in the year you get paid dividends. You will only pay taxes when you start living off your dividends in retirement. When you start making withdrawals and using your income, that income will be taxed as ordinary income. But the vast majority of people will earn less money in retirement compared to when they're working. This will result in a lower tax bill for most people because assuming you're making less in retirement, you'll be in a lower tax bracket. But of course, the reality of investing inside of a retirement account means that you'll have to wait to withdraw money from it. This eliminates the possibility of retiring early off dividends or using your dividend income as another income stream. So let's look at some ways that you can reduce your tax burden while investing in a non-retirement account. Depending on what dividend or distribution paying investments that you have, they can come with different tax rates. Individual non-alternative stocks, some ETFs, and closed-end funds pay qualified dividends. Individual alternatives like REITs and BDCs, as well as some ETFs and closed-end funds, come with non-qualified distributions. Qualified dividends are taxed at a lower rate, and if it's your only source of income in retirement, they can actually be tax-free up to a certain amount. Non-qualified dividends are taxed the exact same as income you'd receive from a job or a rental property. If you're really anti-tax, you can focus solely on dividend investments that paid qualified distributions. So at this point, you might be thinking, okay, I'll only hold qualified dividend-paying investments. That must mean it's always the better deal. And the answer to that is no, it isn't. Being this tax-averse can be detrimental to your retirement. Nearly all qualified dividend investments come with very low yields. In order to get a good understanding as to why this is a bad idea, we need to run the numbers. Take this example. Assume you have $750,000 saved up for retirement. You decide to put all of that money into the Vanguard Dividend Appreciation ETF, ticker VIG, for the sake of keeping things simple. All dividends paid by this ETF are qualified. VIG currently yields 1.65% as of the making of this video. This is pretty normal by S&P 500 stock standards. A $750,000 investment into VIG means that you'll be making $12,375 every year in dividends. All of that income is taxed at 0%, so you get to keep the full $12,375. Again, these results can vary depending on where you live, such as what state you live in, which you'll also have to take into account besides federal taxes. Always speak to a tax professional if you want to know exactly how much you're going to owe in taxes. But now let's put that same $750,000 into a fund that doesn't pay qualified dividends. We'll take all of that money and put it into PFFA, a preferred stock ETF that currently yields 9.73%. Now, not all the dividends paid by this ETF are taxed as non-qualified. There's actually a mixture of multiple dividend sources. But for a very basic example, just follow along with me. We're going to assume the worst case scenario. Let's assume that every dividend paid by this ETF is going to be taxed in the worst possible way. But instead of earning a little over $12,000 per year, you'd be earning $72,975 every year. Now, there's obviously a tremendous difference between $12,000 and $72,000 per year. We could use a tax calculator to find out what we'll owe, but clearly, even if the $72,000 was taxed at 80% or something egregious like that, then you would still be making more than the qualified dividends. The highest tax bracket is 37%, which you will be in if you happen to be making $750,000 per year in retirement. The vast majority of people obviously don't earn this much in retirement, but if all of this income was taxed that high, you would still keep $45,974.25. Does it still sound like it's worth avoiding taxes? I didn't even really cover closed-end funds in this video, which are a little more complicated but not too bad. These investments have 4 different dividend sources, and if you're most concerned about taxes, then find CEFs that pay distributions from mostly tax-advantaged sources. There's other options that exist that you can use to adjust for dividend taxes. If you're still working a job, you can elect to have your employer withhold more from your paycheck to cover taxes at the end of the year. You can also go into your brokerage account and for a couple months out of the year, change the dividend elections on your holdings. You can, instead of always reinvesting your dividends, have them transfer to your bank account to cover the cost of your dividends for a little bit. Just be sure to switch the elections back after you've transferred enough. So those are some reasons why I think it's foolish to not consider dividend investing because of taxes. Let me know your thoughts and if you agree or if you think I'm completely wrong about anything or everything. I am not a tax professional and this video is for entertainment purposes only. If you have any questions, please speak to a tax professional. I will not calculate your taxes for you, so please do not be one of those people who asks. But with that being said, thank you for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.